Did you know that 80% of large-cap fund managers failed to beat the S&P 500 over the last 15 years? Yes, you heard it right. Now, this surprising statistic isn't meant to discourage you, but rather to highlight the challenge of outperforming the market. You see, the stock market is a complex dynamic entity, with countless variables influencing its movements. To consistently outperform the market, one has to accurately predict these variables, a feat that even the most seasoned fund managers find challenging. But what if I told you there's a simpler, cost-effective way to invest? Welcome to the world of index fund investing. Instead of trying to beat the market, index fund investing involves tracking a specific market index such as the S&P 500 or the Dow Jones Industrial Average. Now, you might be wondering, why would I settle for matching the market when I could potentially beat it? Well, let's delve into the benefits of index fund investing to answer that. First off, index funds offer instant diversification. With a single investment, you gain exposure to a broad range of stocks within the index. This reduces the individual stock risk, as the performance of your investment isn't tied to a single company's fortunes. Secondly, index funds typically have lower expense ratios compared to actively managed funds. This is because they don't require a team of analysts and fund managers to make investment decisions. Lower costs mean more of your money goes towards your actual investment. Lastly, let's talk performance. While it may seem counterintuitive, studies have shown that index funds often outperform actively managed funds over the long term. The primary reasons for this are the lower costs and the broad market exposure that index funds provide. So, instead of trying to outsmart the market, why not just ride along with it? After all, as the legendary investor Warren Buffett once said, our favorite holding period is forever. That's the power of index funds. Let's meet John, a long-term investor who decided to invest in an S&P 500 index fund 20 years ago. Imagine John, just a regular guy, not a Wall Street whiz or a market guru. He decided to jump into the world of investing with a simple strategy. He chose an S&P 500 index fund, essentially buying a tiny piece of 500 of the largest US companies. And then, he just let it sit. He didn't try to outsmart the market or chase the next hot stock. Instead, he embraced the power of diversification, spreading his risk across many companies. This approach meant he didn't have to lose sleep over the fate of a single stock. John also enjoyed the low costs associated with his index fund. Unlike active funds, which can have higher fees due to the costs of research and trading, John's index fund had a low expense ratio. This meant he kept more of his hard-earned money working for him in the market. Over time, John watched his investment grow. Sure, there were ups and downs, but he stuck with it. He didn't panic during downturns or get greedy during booms. Instead, he stayed the course, reaping the benefits of broad market exposure. John's story shows that patience, not prediction, is the key to long-term investing success. Now that you understand the benefits of index funds, you might be wondering how to get started. Well, you're in luck, because investing in index funds is as easy as pie. It all begins with choosing your fund. Look for an index fund that tracks a market index you're comfortable with, one that aligns with your investment goals and risk tolerance. It could be a fund that tracks the S&P 500, the Dow Jones, or any other index that you fancy. Next, you'll want to open an account. This could be a brokerage account or an investment account with a financial institution that gives you access to the index fund you've chosen. It's like setting up a new email account, but this one can make you money. Once you've got your account, it's time to decide on the magic number. How much do you want to invest in the index fund? Remember, it's not about having a lot to start, it's about starting. And now, the final step. Place your order. It's as simple as buying a book online. You're purchasing shares of the index fund through your shiny new account. But when should I invest? You might ask. Well, index funds are a great choice for long-term investing. You could also consider a strategy called dollar cost averaging, where you invest a fixed amount regularly over time. This helps to smooth out the ups and downs of market volatility. As for where to invest, many mutual fund companies and ETF providers offer index funds. It's like shopping for groceries, but instead, you're shopping for your financial future. As you can see, investing in index funds is straightforward and accessible, even for beginner investors. In a world where time is money, passive investing is the future. The rise in popularity of index fund investing is a testament to this. It offers simplicity, cost-effectiveness, and the potential for long-term growth. This makes it a suitable choice for those seeking a passive investment approach. It's about buying and holding, not timing the market. So, are you ready to join the world of index fund investing? Remember, the best time to start investing was yesterday. The second best time? Today. Leverage on bullbearvector.com to find the right stocks and options to invest, helping you to save time and reduce costly mistakes today.